The stock market is something that comes up in all sorts of places, but how it works is never really explained. We'll fix that for you, giving you a basic understanding of how the stock market works by first making sense of its main elements, then looking at the idea behind stocks, and finally exploring how the stock market has grown to become a thermometer of our world's condition. In the stock market, there are three main players, each with an important role: the marketplace, investors, and stocks. A stock is simply a business. Just like a cake is divided into pieces, a stock is divided into shares. If you buy a share of stock, you become a part owner of the business proportionate to the size of the piece you've bought. This makes you an investor. An investor can be a person or another business, and they are involved in buying and selling shares. Essentially, it's just a cooler word for part owners of businesses. Like all trade, these transactions need a marketplace. The marketplace for stocks is a stock exchange, which is like a store full of stock shares. But why would anyone want to sell a part of their company? The simple answer is that it helps the world develop much faster. Let's say you own a vending machine that earns $100 a day. You believe that having another vending machine on the other side of town would double your earnings. But buying a new vending machine costs $1,000, which you don't have. This is where the idea of stocks comes in to solve the problem. By turning your vending machine business into a stock with 100 shares and selling 40 of them for $25 each, you raise $1,000 to buy a new vending machine. Since you still own 60% of the shares, you remain the main boss and retain control of the company. You can also buy back shares later if you want to increase your ownership stake in the business. How does this help the world develop faster? If we look at companies that build houses, when funds run out, they have to be cautious to avoid bankruptcy, and innovation and development slow down. With investors' money, new inventions can be made that bring the world forward. Usually, an investor wants to buy stock shares when they believe the price will rise in the future, enabling them to sell it at a higher price and profit. But this raises another question. Who decides the price of a stock share? When you list shares for sale on the marketplace, you set the price at which you want to sell them. Potential investors assess your business and estimate the value of the shares they want to buy. If their bid matches your selling price, a trade can be executed. There are many reasons why stock prices fluctuate constantly. Let's examine an example of how a small piece of information can significantly impact the stock price of our vending machine business. In this scenario, where the business is purchasing another vending machine and potentially doubling its earnings, investors will likely be willing to pay more for a stock share. As the business generates more profit, its overall value increases, leading to a rise in stock price. This can create a situation where investors bid against each other because there are more buyers than sellers, thereby driving the stock price far beyond the business's current value. On the other hand, if it turns out that the new vending machine isn't working as expected, investors will realize the business is earning less money. Reduced earnings make the business less valuable, prompting more investors to sell their stock than buy. This can lead to sellers undercutting each other and lowering the stock price. Whether rising or falling, the market tends to overcompensate, much like humans. When you stubbed your toe this morning, it didn't have to ruin your entire day, but you let it because you're a drama queen. Similarly, the overcompensation in stock prices is driven by human emotions, influencing buying and selling decisions among investors. The stock market acts like a thermometer for our economy. But if stock prices are based on how investors feel, It means the entire stock market is influenced by a large number of investors' emotions. How can that be a precise guide for our economy? The prices in the stock market are determined by agreements between sellers and buyers. When the economy is thriving and people are optimistic about the future with more money to invest, more investors enter the stock market, driving up stock prices. However, during economic downturns, when people feel financially stretched and uncertain about the future, many investors sell their stocks to cover bills and step away from the market, causing stock prices to drop. There are many stock exchanges all over the world, so while the economy might be struggling in one place, it can be unaffected on the other side of the globe. A common thing about the stock market is that we all have that one friend who's convinced they've cracked the code with their genius idea. They tell you how they're going to make a fortune, but you know this friend, and you know they're not the sharpest tool in the shed. The fascinating phenomenon of how someone utterly incompetent can have unshakable confidence in themselves is explained in this video. Now go on then.